You think the AI revolution is about chatbots and algorithms. It is not. The real war being fought right now is over something far older, far dirtier, and far more powerful: land and the electricity flowing through it. A brand new asset class has quietly emerged, one that Wall Street's most sophisticated investors are racing to corner, and almost no one is talking about it. It is called powered land, and understanding it will tell you more about where money and power are actually moving in the next decade than any stock tip or earnings call ever could. Welcome to The Business Architect. Today we are going to expose the hidden infrastructure game behind the AI boom, who is winning it, who is losing it, and what it means for ordinary people like you. Let us start with the basics, and then we will go somewhere most analysts will not. For most of history, the most valuable real estate was defined by location: prime Manhattan, central London, downtown Dubai. That calculus has now been completely shattered. According to a June 2026 analysis by the law firm Ropes & Gray, one of the most respected voices in institutional finance, power availability, not capital, is now the principal driver of investment decisions in the data center sector. Read that again. Power availability, not capital. A site with guaranteed grid connections and pre-approved permits is no longer just land. It is a financial instrument. Developers who can secure these rights have created, as industry insiders describe it, a tradable asset with clear demand from hyperscalers and operators. This is what powered land is: parcels of earth pre-equipped with grid connections, utility permits, and power delivery infrastructure. The keys to the kingdom of AI computing. A traditional office building might consume 15 to 25 watts per square foot. A conventional data center runs at 100 to 150 watts per square foot. But the newest AI training facilities are pushing 300 watts per square foot and beyond, with individual GPU clusters requiring dedicated power feeds that would have been considered industrial scale just a decade ago, according to real estate investment firm PlaceMKR. The consequence of that gap is staggering. The spread between a powered site and an unpowered one is not a premium. It is the difference between being worth $30 per square foot versus $300 per square foot. That is a 10 times multiplier, not on a stock, on dirt. Now let us talk about why this scarcity exists, because it did not have to be this way. Global data center demand has simply detonated. Microsoft, Amazon, Google, and Meta have collectively committed over $300 billion in data center investment through 2026 and 2027. Not projections, not guesses. Committed capital budgets already under contract with construction firms and utility providers, according to PlaceMKR. The hyperscaler market is expected to grow at roughly 25% annually through the end of the decade. By 2025, average vacancy in primary U.S. data center markets fell below 2%, the lowest level in at least 12 years, according to CBRE research. As of early 2025, Dominion Energy Virginia alone had received requests for 40.2 gigawatts of power connections from data center developers, up from 21.4 gigawatts just 6 months earlier. For context, the entire United States consumed 477 gigawatts of electricity in all of 2023. So data center developers are requesting nearly the equivalent of all U.S. power consumption. And most of it cannot be delivered because the grid simply cannot absorb it in time. The U.S. could see roughly 200 gigawatts of new AI-driven electricity demand by the end of the decade, while also retiring more than 100 gigawatts of existing capacity, according to Prologis Mobility. Transformer lead times now exceed 3 years. Grid interconnection queues hold more than 1,500 gigawatts of projects awaiting approval across North America alone. Grid operators in Northern Virginia, Dublin, Amsterdam, and Tokyo have imposed moratoriums on new data center approvals. This is not a temporary bottleneck. This is structural scarcity, and structural scarcity creates the most lucrative investment opportunities of any generation. This is where it gets really interesting, and where the hidden money starts to appear. In August 2025, private equity giant Silver Lake, one of the most sophisticated technology investors on the planet, launched a $400 million powered land platform in partnership with Commonwealth Asset Management targeting the US, Canada, and the UK. The platform has already secured 3 gigawatts of capacity in Texas and Georgia, with plans to reach 6 gigawatts across North America through utility partnerships and on-site natural gas generation, according to Business Wire. Silver Lake is not alone. Blackstone, Brookfield, KKR, and Equinix are all competing for the same small inventory of power-ready sites, driving internal rate of return expectations for ground-up data center development in power-constrained markets between 12 and 18%, well above the 7 to 9% typical for industrial development in the same geographies, according to the AI Consulting Network. Hines, one of the world's largest real estate firms, has dramatically pivoted, shifting from building data centers to securing powered land sites as the upstream play. Brookfield Asset Management has formalized a $100 billion program targeting data centers, power generation, and transmission assets in a unified strategy, signaling that institutional capital now views AI infrastructure as a multi-decade growth platform. The financial engineering behind all of this is extraordinary. According to the Ropes and Gray analysis, platforms are land banking assets in development vehicles and tapping the emerging market for land cost facilities, essentially treating power rights the way oil companies treat reserves. Capital structures are evolving at speed. GPU financings, land cost facilities, and hybrid structures collateralized by contracted asset bases are all emerging as tools for this market. Some participants are splitting power from real estate entirely, allowing different investor bases with different return profiles to participate in the same platform. Outside capital is now arriving earlier in the development lifecycle than ever before, meaning investors are underwriting future AI demand years before a single server rack is installed. Now let us talk about the credit markets, because this is where the hidden story truly lives. The world's largest hyperscalers have, for years, self-funded their data center costs out of their own enormous cash flows. That era is over. An estimated $5.3 trillion will be needed to support AI infrastructure development through 2030, according to JP Morgan. About half of this is projected to come from external capital, meaning debt markets, private credit, and structured finance must absorb trillions of dollars that hyperscalers cannot fund from their own balance sheets. The numbers that have already moved through the bond markets in 2026 alone are almost incomprehensible. Alphabet raised more than $85 billion of debt across 6 currencies in just the first quarter of 2026. Amazon completed a single $37 billion investment-grade bond offering, the largest in the U.S. market before NVIDIA's deal. Meta and Oracle each issued $25 billion, and in June 2026, NVIDIA priced a $25 billion bond offering, drawing $85 billion in investor orders, including a 30-year tranche maturing in 2056, which is effectively a bet that AI infrastructure financing will last 3 decades, according to Tech Times. AI-related borrowers have sold approximately $300 billion in bonds in 2026 alone, according to Barron's. Morgan Stanley projects hyperscalers will collectively issue $400 billion in bonds in 2026 alone, up from $165 billion in 2025. The combined capital expenditure of the 5 largest hyperscalers is projected at nearly $690 billion for 2026, up 81% from 2025 and 207% from 2024, according to credit sites. And analysts at Wall Street Consensus project this reaching $930 billion by 2028, with a total of $4.7 trillion from 2025 to 2030. A big focus for credit markets in 2026 is securing data center financing, with mega-cap hyperscalers tapping their own cash flows for about half of spending while debt markets cover the rest. The ABS, asset-backed securities, market for data centers currently stands at about $25 billion, but faces projected takeout needs approaching $300 billion, according to Ropes and Gray. This gap is the next financial earthquake waiting to happen. So who wins? And who gets hurt? Let us be specific. The winners in this shift are clear. Electric utilities with existing transmission infrastructure in data center corridors, companies like Dominion Energy, Duke Energy, and Georgia Power, are suddenly sitting on assets of strategic national importance. Investor-owned utilities collectively reported profits rising from $38.8 billion in 2021 to $52.5 billion in 2024, with margins rising further to an average of 14.6% in 2025, according to Fortune. Cooling technology companies are emerging as critical infrastructure. Liquid immersion cooling systems can achieve up to 1,200 times the thermal efficiency of air cooling, slashing power usage effectiveness to near 1.1, according to Data Center Limited. Construction materials suppliers, copper, cement, and steel, are seeing surging demand as data center construction requires enormous quantities of these commodities, creating bottlenecks across global supply chains. Nuclear energy developers are experiencing a dramatic renaissance. Hyperscalers are seeking reliable 24/7 baseload power that cannot be delivered by intermittent renewables alone, and nuclear offers the closest thing to guaranteed power delivery. Real estate investment trusts, REITs, focused on data centers are compressing cap rates dramatically. In Atlanta, data center property cap rates compressed from 5.5% to 4.8% during 2025 as institutional buyers flooded in, according to the AI Consulting Network. The losers are equally clear. Traditional commercial real estate, offices, retail, even logistics, is being outcompeted for the same institutional capital that now prefers the 12 to 18% returns of powered land over the 7 to 9% of conventional industrial. Legacy coal plant operators face a bizarre irony. Some retirements are being delayed to meet AI data center demand at enormous refurbishment cost, while simultaneously facing the long-term threat of being replaced by purpose-built power infrastructure. Semiconductor manufacturers face a memory supply crisis. Leading producers Samsung, SK Hynix, and Micron report that most advanced high-bandwidth memory production through 2025 and 2026 is already allocated through long-term agreements, creating delivery lead times of over a year, according to Telecom Review Asia. The geopolitical dimensions of this shift are profound and almost entirely absent from mainstream coverage. The United States currently has 3,960 data centers, more than the next 14 countries combined, and is the dominant beneficiary of the AI infrastructure spending supercycle, according to Visual Capitalist. But the map is being redrawn aggressively. In Southeast Asia, Malaysia has emerged as the most surprising winner. The country now has more than 500 operational data centers, roughly 300 under construction, and 1,140 planned, with the Prime Minister confirming in February 2026 that all new data center applications unrelated to AI have been stopped, concentrating only AI beneficial projects, according to Digital in Asia. Thailand attracted $16.13 billion of data center investment approvals in just the first half of 2025 alone, with Microsoft, Amazon, Google, and ByteDance all committing multi-billion-dollar presences there. The Middle East is emerging as a new AI hub, leveraging sovereign capital, vast land resources, and modern energy infrastructure. With Saudi Arabia, Qatar, and UAE all backing gigawatt-scale AI campuses, with sovereign wealth funds moving directly onto investment cap tables, according to S&P Global. Europe tells a more complicated story. The EU has committed $30 billion to build AI data centers, but transmission bottlenecks are slowing rollouts in London and Dublin. PJM capacity prices in the US have surged 11 times since 2023, and France attracted $69 billion in foreign data center investment in 2025, more than any other country. Yet 26% of its planned facilities are classified as high physical climate risk, according to XDI. India is opening its arms to global data center investment, but communities across the US, Europe, Latin America, and Southeast Asia are increasingly resisting such projects over their heavy demand for water, electricity, and land, according to Down to Earth. In 2025, local opposition in the U.S. alone delayed or blocked data center projects worth up to $152 billion, according to Data Center Watch, a resistance movement that is bipartisan and growing. The countries that win this race will be those that can offer something increasingly rare: abundant, affordable, reliable electricity, combined with political stability and permitting speed. Now, for the part that no one in finance wants to talk about, because it hits people where they live. Literally, electricity prices in the U.S. jumped 6.9% in 2025 year over year, more than double the headline inflation rate of 2.9%, according to Goldman Sachs. Before 2019, electricity prices had been flat at around 13 cents per kilowatt hour for more than a decade. By the end of 2025, average electricity prices rose to 19 cents per kilowatt hour, a 27% increase, according to the U.S. Energy Information Administration. Goldman Sachs projects that prices will continue to rise through the end of the decade as data centers account for 40% of all electricity demand growth, lowering disposable income and dragging down consumer spending. In areas near high concentrations of data centers, the situation is more severe. Bloomberg analysis found electricity prices jumped 267% over 5 years in some of these zones. In central Ohio, one homeowner told NPR his electricity bill went from 12 cents per kilowatt hour to 19 cents, a 60% increase, as 130 data centers were built in his region. The Institute for Energy Economics and Financial Analysis told NPR that ordinary people are going to end up subsidizing the wealthiest industry in the world, unless the rules are reformed so data centers pay more of the cost of grid expansion themselves. About 21 million U.S. households, 1 in 6, are behind on their utility bills. Total outstanding utility bill debt reached $25 billion in June 2025, up from $15 billion in 2022. Utility shutoffs skyrocketed to 3.5 million in 2024, according to the Environmental and Energy Study Institute. Meanwhile, data centers, consuming more electricity than ever, pay rates that have risen only marginally. Residential prices rose 10% over 2 years, while commercial rates rose 3% and industrial rates actually fell 2%, according to Yale Climate Connections. This is the K-shaped economy in pure, unambiguous form. Utilities themselves are posting record profits. Collective profits at 110 publicly listed utility companies rose from $38.8 billion in 2021 to $52.5 billion in 2024, while margins hit a preliminary 14.6% in 2025, according to Fortune. This has become intensely political. In November 2025, 2 utility commissioners in Georgia were voted out in a landslide after presiding over a 41% electricity price increase in 4 years. New Jersey's incoming governor promised to freeze utility bills. It has become a rare area of bipartisan political alignment. Both Democrats and Republicans are raising alarms. Electricity prices are expected to increase by up to 40% by 2030 compared to 2025 levels, according to the U.S. Energy Information Administration. So what does all of this tell us about where the world is actually heading? The fourth quarter of 2025 was, according to analysts at Global Data Center Hub, the quarter that AI infrastructure crossed the line from commercial real estate into strategic national assets. This is not corporate real estate anymore. This is not a tech sector story. Governments have stopped reacting and started designing. Sovereign wealth funds have moved directly onto investment cap tables. Hyperscalers have locked in multi-gigawatt power corridors. Private credit has replaced equity as the primary fuel for expansion. Energy security, not latency, not land, has become the defining competitive advantage of the AI era. The financialization of AI infrastructure is accelerating. Institutional investors are preparing to package stabilized hyperscale portfolios into public market vehicles offering predictable cash flows and long-duration AI demand exposure. Structures that will invite pension and insurance-scale capital into the sector. Nearly 100 gigawatts of new data center capacity will be added globally between 2026 and 2030, representing approximately $1.2 trillion in real estate asset value creation, according to the AI Consulting Network. The winners in the next decade will not be the companies with the best algorithms. The winners will be the entities, companies, governments, or funds that control the physical ground beneath those algorithms and the electrons flowing into them. Powered land is not a subsector of commercial real estate. Powered land is the new oil. That is the hidden architecture of money and power that almost no mainstream outlet will connect for you. Silver Lake is buying it. Brookfield is buying it. Blackstone is buying it. And while they do, your electricity bill keeps climbing. The question is not whether you are affected by this shift. You already are. The question is whether you are going to understand it or whether you are going to stay in the dark, paying the bill for someone else's trillion-dollar infrastructure play. If you want to go deeper on any of the sources cited in this video, or if you want to discuss the investment and geopolitical implications privately, you can reach me on Signal at the Business Architect 123.43. That is the Business Architect 123.43 in Signal. If this video opened your eyes, share it with one person who needs to see it, and subscribe to the Business Architect, because this is only the beginning of what we are going to uncover together.